Tom, coming out to you here, big mention by you on your note this morning on tech stocks. Are you a buyer of the dip here?
Good morning, Brian. Thank you very much for having me on. No, not this morning, because I think that there could be some more volatility ahead. I don't think we've sort of come down enough. I think if we can get another couple days, say get the market, 3 to 5% off the highs, I think then it becomes more attractive. Because while all these tariff headlines have created surprise volatility, the market still believes in taco, which is Trump always chickens out, until it's proved otherwise. And so I think that will give the market some cushion, but not at these levels. I mean, as you just said in the intro, we're very stretched by any number of measures, and this tariff chaos is a surprise.
So, Tom, does this situation, where it stands today, will this test this view that you must buy every dip in the market? I mean, this is a strategy that has worked very well for investors. It even worked quite well after the Liberation Day massacre, provided your time horizon is more than a day.
Yeah, I think it will test it again because the sheer volume of chaotic headlines coming out of the administration is frankly a lot even for them. If you think about it, now obviously the Greenland is the latest thing, but we started the year with Venezuela. Right now we've sort of lurched into pointing right at specific industries. The credit card companies charge too high interest rates, healthcare costs, insurance costs are too high, defense companies are too favorable to their shareholders. And then, of course, we have the whole Fed situation where Fed Chair Powell is going to be sitting in on the Supreme Court hearings in obviously sort of a protest against what's happening with Fed Governor Cook. So the sheer volume will test the taco theory, but I think that it still gets the benefit of the doubt. Trump is not going to willfully drive the markets or the economy into the ground. At least we hope not.
Tommy, make some good points there. In terms of surprises, I'm just making this list here so I have it for after the show. Venezuela, credit cards, Powell, and tariffs. Brooke, one headline that caught my attention this morning, and maybe I shouldn't be surprised, is a potential 200% tariff on champagne that the president floated. I mean, walk us through this.
So essentially where that came from was this potential threat that, as you noted, President Trump floated out there after French President Emmanuel Macron said that he wouldn't join this peace initiative that President Trump seems to be forming here. And so, as our producer John Hyland said, we won't be toasting anytime soon because this potential 200% tariff threat is now lingering in the air. And based on multiple different sources that I've really spoken with over the past year, as we've heard this before. We've seen this threat on wine, spirits from the entire EU last year. That specifically today is for French champagne and French wine. But this is a big hit for especially trickling all the way down to liquor retailers who now have had to assess over the past year their inventory, potentially take certain kinds of champagne, of wine off the shelves, and ultimately try not to, but at some points float this higher tariff, this higher import cost to consumers at the end of the day. And so while this is now lingering in the air, this could have serious implications for the end game here for consumers and also key names that do produce overseas.
Yeah, John Hyland, a big champagne fan. So good to see him called out here on Opening Bid.
Ben, I want to get started with you. And a little context here I think is necessary because although the president has talked about Greenland for a while, he brought it up in his first term as well, for people who are watching, why Greenland? Why the focus, and one might even say fixation on Greenland right now?
Right. What I think is making this issue especially confusing is that you get two different answers to that question just from Trump himself. You mentioned the national security parts at the top. This is a combination of oil, rare earth minerals, missile defense, all these issues that Trump talks about most commonly as his reason for wanting Greenland right now, to take it into U.S. control from Denmark. Frankly, the facts, there's a lot of holes in that based on the fact that the U.S. oil companies, rare earth companies, and the U.S. government itself has a lot of access to Greenland already, and that's not expected to change. So that's the national security case that Trump is making. He made it again last night in a series of overnight posts. But the other point here, I think, is that he's also saying clearly that this is partly kind of personal to him. He sent a message to Norway's leader over the weekend that partly here is that he feels he's emboldened to take Greenland because he was denied a Nobel Peace Prize. He said, as he put it, he doesn't have to think purely of peace anymore. Not only did he send that message to Norway, he then his team forwarded on to a bunch of other European leaders. So there's clearly kind of a personal element here, a fixation on getting this, as you put it, to sort of because of this Nobel issue, but also kind of a larger priority. As you mentioned, he's been talking about this since the beginning of his first term.
And so what are the, for people who weren't following all the blow-by-blows over the weekend, what levers is he now threatening to pull if he doesn't get the buy-in of the rest of Europe on this?
Yeah, so there's these tariffs are his main lever he's trying to pull. It's 10% tariffs starting next month, 25% going forward. There's a lot of questions about whether this is a threat to kind of increase his security, U.S. security guarantees in Greenland or more. He's also talking about tariffs kind of more broadly. He's threatening new tariffs on France. That's over a sort of separate issue of a peace institute he's trying to get started around the issue of Gaza. So it's all kind of tariffs. It comes back for Trump for tariffs. Tariffs are the way he thinks he can kind of get everything he wants. This is a trend we've seen in the entire first year of Trump's term. It also comes, I would note, as the Supreme Court is sort of set to have a decision on the legality of a lot of Trump's tariffs, potentially today, but at least in the next few months.
And Catherine, all of this is happening amidst the backdrop of the World Economic Forum in Davos, where a lot of these world leaders, including President Trump tomorrow himself, are going to be speaking. And President Macron of France just spoke and kind of raised the possibility of countermeasures from Europe, but kind of tried to play it down. What do you make of the reaction we're seeing in the markets and how seriously you think, or not, investors are taking all of this?
I think the market is reacting to the downside probably because of the escalation of tariffs more than the threat to Greenland. I'll add to Ben's point. I think the U.S. already operates key radar and space infrastructure in Greenland, so we have a presence there. But my understanding is that Greenland is for sure a security issue. You know, it centers on Arctic defense, missile warnings, and critical minerals. And as ice melts, my understanding is that Arctic shipping lanes expand.
Well, but Catherine, if I may interrupt you for a minute, is the rationale sort of irrelevant? Isn't it more relevant that the president is trying to take over something that belongs to a NATO member and is threatening these tariffs? I mean, is like the rationale, say what you will about it, but
I think it is relevant because this is not like an invasion. So this is not something that's going to, send the markets reeling because Trump invades Greenland. I think what's happening here is he's trying to build the NATO presence and buy Greenland. So that my answer to you is that I don't think this is going to send the markets reeling. His argument is that Russia has militarized the region. China says they kind of own the Arctic Circle now, and Denmark can't defend Greenland, which is in our own backyard. I think, Julie, what's happening here is that this is part of Monroe Doctrine 2.0. We saw it in Venezuela. You can't compare the two because Venezuela is a different scenario, but this is part of, this is our neighborhood. We're going to defend it. I don't think the markets are going to care that much. I think today the markets are down. Things are going to resolve. You can see the Trump playbook and things certainly, I think, in my view, resolve. So I care very little about this, honestly, Julie. I think that what we should be focused on is rates. I think rates set the tape. I think if we get fiscal profligacy continuing to the upside, if we get a resurgence of inflation, all bets are off. I think the market drops. That's not my base case, but I'm way more concerned about that than I am about Greenland or 10% tariffs, because we've seen this playbook before. We saw it last year. Markets don't care. Inflation was minimally affected. Economic growth is above potential. I think the biggest risk from my perspective, Julie, going into this year is an overheating of the U.S. economy, a resurrection of inflation, because the economy is growing so well. So yeah, Greenland is not the main focus for me or for my investors.
When you talk about fiscal, though, I mean, if we bought Greenland, presumably it wouldn't be cheap. I mean, that would be spending, right? I mean, that would be a big spend.
Yes. Yeah, I don't think it'll blow away the deficit. I think we're already doing that. I mean, we have 6.5% fiscal deficit, and the main drains on the fiscal accounts are not the purchase of Greenland. They're the ever-growing cost of entitlement programs. That's the main drains on our fiscal account. And now it's interest payments, right? So interest payments now exceed, and by a large amount, defense spending. So it's interest payments, Medicare, Medicaid, and Social Security. I don't think that changes. I think fiscal deficits stay markedly above pre-COVID levels. And I think that just leads to a new normal of inflation. We're going to get inflation of 2.5% to 3%, and that's the new norm. I think the Fed can't cut to pre-COVID levels ever again. So we're probably seeing a Fed that drops rates max 2 times this year at 25 basis points each, unless we get a surge on unemployment. And that would have to, in my view, break 5% for the Fed to move more than 2 times.
Ben, you mentioned that it's possible that we could get a Supreme Court ruling on the tariffs today. We know they're in session and they've been sort of coming out with rolling rulings. Is what the president is threatening over Greenland, does that influence the case? I mean, I know the arguments have already closed, et cetera, but because it is a different kind of threat over a different issue, does that have any effect or bearing on the ruling?
I mean, it doesn't necessarily have an effect on this decision. As you mentioned, the arguments are already done, and the justice may be considering that. They have not outlined exactly how he's going to follow through on these threats. It would presumably be these IEEPA tariffs. This is what the Supreme Court is deciding is legal one way or the other. These blanket tariffs that Trump is imposing, this is how he's imposed his other tariffs. The Trump administration has said that they're going to follow up these tariffs, even if they have a negative ruling, with other authorities. Section 301 is a major one. A lever they could pull to kind of essentially replace these International Emergency Economic Powers Act base tariffs with a different authority going forward. So I don't know that it affects the decision. It definitely affects kind of how easily or how quickly Trump can add or subtract tariffs in the days ahead to follow up on this threat, as well as keep his other threats going forward.
And Catherine, it feels like most of what you're discussing from a sort of fiscal and monetary policy backdrop, for that matter, sort of leaves aside any tariff back and forth, right, and sort of the short-term stuff that's been going on. So given the backdrop that you're talking about, what are the implications for equities, for rates, for other assets?
Yeah, I think that if inflation expectations remain stable and anchored and the 10-year doesn't fly, I'm talking, above 4.5%, I think S&P does well this year. Earnings are pretty good. Tariff revenues are at $300 billion, so that's not talked about quite a bit, but we have had an influx of cash into the coffers, and that is relevant without a market jump in inflation nor recession, which many of us, including myself, called, and we were wrong. So I think that markets do well this year, unless we get rates selling off, because of course discount rate sets the tape for everything. So it's less about earnings, in my view, Julie, and much more about where rates go. If they stay low, if the Fed can cut, inflation doesn't resurge, then I think we can get another 10% upside in S&P, which is historically unusual to have so many years of double-digit growth.
It is. We'll see if it happens. Catherine, thank you so much. Good to see you. Ben, thank you. Appreciate it. Scott, thanks for being here. And I know that you have been sort of laser focused on tariff policy and the tariff impacts on the U.S. economy. So obviously we have a new tariff threat, but it's sort of a different kind of tariff threat. And I'm curious what you make of it and what you think the outcome is going to be.
Well, you always, with Trump tariff threats, have to wait to actually see a official legal document. So I think, for now, we are in wait and see mode to see the timing and whether it even actually happens, the legal justifications as well. With the Supreme Court ruling sometime in the next few weeks or months about Trump's emergency tariffs that will potentially conflict with these new tariffs again if we ever see them. I think the bigger takeaway here, though, is about the effect of tariffs and tariff uncertainty on the U.S. and global economies. If you listen to businesses last year, particularly American manufacturers, a lot of them said, hey, look, we can deal with the tariffs, but it is the uncertainty. It is not knowing what the rates are going to be in a week or a month that's really killing us. And I think this Greenland drama really hits home that, contrary to a lot of analyst predictions, 2026 is still going to see a lot of this stuff going forward, whether it's on Greenland or anything else.
Well, and Scott, we just learned a little while ago that we are not going to get a Supreme Court ruling on tariffs today. But that's also another sort of element of volatility in this whole situation, because we've heard from the administration that even if the Supreme Court overrules some of the tariffs, that they have sort of backup plans to reinstitute them.
Yeah, exactly. The Supreme Court decision is important for a lot of reasons, but more on the executive power side than really on the tariff rate side, because the administration has other laws at its disposal that'll let it effectively recreate its global tariff regime just in slightly different ways. Now, that might give us a little more notice. It might put a little more structure on these tariffs, but it's not going to change overall tariff rates much, and it's certainly not going to end this uncertainty. And I think as well the complexity of all of this, because you're not talking about one flat tariff rate on all goods. You're talking about wildly different tariff rates by country, by product, by content. And then, of course, there are exclusions and new deals, and then Trump trade through social posts. Put it all together, and it's just a brutal business environment, particularly for American manufacturers that are deeply enmeshed in these global supply chains.
I want to get more into manufacturers, but first I want to ask you this, Scott. I mean, the Trump administration itself, and a lot of investors we talk to would say, get over it. The U.S. economy is in great shape. Markets are in great shape. Corporate profits are in great shape, even with this difficulty and volatility you're talking about. So where's the problem?
Well, with a lot of this stuff, it's always what could have been. There's no doubt that AI, the tax bill, and some of the new corporate tax provisions, easing monetary policy are providing real tailwinds for the U.S. economy. And I think other Trump deregulatory provisions are also helping. But the issue is that the tariffs are just hurting a little bit. They're just taking a little bit off of investment and output and other things. So things could be even better if they weren't causing these own goals. And then, of course, you got to remember that beyond the macro level, you're talking about a lot of businesses, particularly smaller businesses, that are really struggling in this tariff environment. And those types of pains, I think they get washed out by all the macro obsessions, but they're real. And, with bankruptcies going up last year and other things, they're starting to bite.
Well, I want to talk a little bit more about the goal of the tariffs, right? We're now 1 year into Trump's second term as president, and one of his explicit goals for the tariffs was this renaissance in American manufacturing, right? And here we are, and it certainly hasn't materialized yet. And I'm curious if and when you think it is going to materialize.
Yeah, like I said, there are some of those tailwinds that should push manufacturing forward this year. It does appear that we're in a kind of an upward trend in the business cycle generally. But the reality is that American manufacturing is very much global. About half of everything imported into the United States are industrial inputs. So the things that American manufacturers need to make other stuff and stay globally competitive. Combined that, so the additional tax expense and higher prices for steel, aluminum, and metals, you combine that with all of the uncertainty, and what you've seen is a manufacturing sector so far that's just kind of stuck in neutral. It's hemorrhaging some jobs, but job openings are down generally. Output is up a bit, but really not doing much. The soft data from these surveys are pessimistic and have been for the year. And that just reflects the fact that, when you throw a bunch of this tariff sand in the gears of these finely tuned supply chains, it doesn't mean it's going to be catastrophic, but you're not seeing a boom. And I would expect this year similar types of fits and starts to continue.
What would change that? If assuming that the tariffs are not going anywhere, is there anything else that would change or improve that picture?
Yeah, you would need to see a pretty radical decrease in the uncertainty of all of it. If you actually could get to a situation where tariff rates are relatively uniform and transparent, and they're not changing every week or month, and some of that complexity gets ironed out, and businesses are allowed to have a consistent and predictable environment for their business, for their sales, for their supplies, then you might be able to see those tailwinds really push the sector forward. But unfortunately, that just seems highly unlikely, particularly with the president's love of threatening people with tariffs, and with all of those laws, including the ones the Supreme Court is looking at, that allow the president to effectively flip tariffs on and off like a light switch in the Oval Office.
Mark, it's good to see you. So the Clarity Act is sort of the pipes around regulation, sort of the nitty gritty of how cryptocurrencies, how stablecoins, how tokenization is going to be regulated. What, in your view, needs to happen to get this thing over the finish line?
Yes, well, this is an absolutely critical bill in terms of creating the rules of the road for the crypto space, so that institutional investors who have been reluctant to get involved because of the lack of those rules can do so in earnest. And that really represents the next leg up for the crypto space in terms of the growth of the ecosystem, crypto prices, the support for all of the different crypto companies that have come onto the market. The single biggest point of contention with regard to the bill has to do with yield and interest on stablecoins. Stablecoins, of course, are backed on a one-to-one basis by U.S. dollars. They are used for payments, for money transfers, for settlement. But the Genius Act, which was passed last June, said that there could not be any yield or interest on stablecoins, but there was a bit of a loophole where third parties, such as a Coinbase, could offer yield on those stablecoins. Now the banking lobby, which is seeing this as a threat to commercial deposits, is going after that provision, wants to make sure that even third parties are not able to offer those sorts of yields. And so that's where we are right now, trying to find a compromise between the banks on the one side and the crypto entities that would benefit from being able to offer yield on stablecoins on the other.
And Mark, just to make sure I understand this, so stablecoins are backed one-to-one with the dollar, and they're backed because companies like a Circle own U.S. Treasuries, which are yield-producing instruments. So is the idea that they would pay out some portion of that yield to stablecoin holders?
Yes, that's the way that things work, in essence, with a company like Coinbase. If you own USDC stablecoins through Coinbase, you can earn a yield of 3.5%, which, of course, is much more favorable than the tiny amounts of interest that can be earned in commercial deposits in banks. As such, the banking lobby has said that $6 trillion of U.S. commercial deposits would be at risk, simply because consumers, seeing that they could earn 3.5% and more on stablecoins, would go in that direction. That would suck deposits out of the banking system and ultimately curtail commercial lending and the other means through which banks help to support the economy. That $6 trillion figure comes from a Treasury study. It seems a bit of an exaggeration in our view, simply because most stablecoin usage, again, comes down to payments, money transfers, and the like. But it's clear that the banks see this as a threat. There could well be a compromise here because there are other ways that crypto platforms can generate revenue from stablecoins, particularly by providing what is equivalent to yield or rewards to their customers. One is through staking, which is the means through which new cryptocurrencies are created through proof of stake algorithms, protocols. And another would be by providing liquidity to decentralized finance or DeFi protocols. Either way, there would be the equivalent of yield generated in terms of reward. So there is another way that the crypto platforms can provide a means of attracting and retaining customers on their platforms without offering interest. That may be well where this all shakes out at the end.
Mark, does this, if the bill is going to get through, does it need to get through in the first half of this year? In other words, does getting closer to the midterms imperil any progress on this?
I don't know how you couldn't reach that conclusion that, the closer we get to the midterms, the more likely it is that any sort of major legislation is unlikely to be enacted. For those who are taking a different view with regard to this bill, they don't necessarily want to see the crypto infrastructure built out the way that the bill is proposing, waiting until the Democrats have more power in the House, potentially in the Senate, would create more leverage in that regard. And the ultimate form of the bill, may look quite different than it would if it were to pass at this point. So the closer we get to those midterms, the less likely this is to occur. I think, it's really the next couple of weeks are going to be telling, as we get close to the potential markups of the bill, both in the Senate Banking and Agriculture committees. That should give us a sense of where we stand at that point. But behind the scenes right now, there's a tremendous amount of activity trying to iron out compromises with regard to some of these sticking points.
And just quickly, Mark, which of the stocks that you cover has the most to gain and lose from this bill, whether it goes through or not?
Well, in terms of gaining, I would point to a couple of stocks in particular. One is Galaxy Digital, because as I said earlier, the bill really is about creating a green light for institutional investors to get involved in the space. Galaxy Digital has spent the last 8 years building a state-of-the-art platform designed to facilitate trading of crypto for institutional investors. And so it has attracted quite a bit of business to its derivatives platform, its lending platform, but with regulatory framework in place, its volumes should increase dramatically. The other company, which I mentioned before, is Coinbase Global, which again has a robust infrastructure platform for institutions. It's not the entire business. A lot of Coinbase's revenue, the majority of it at this point, is generated on the retail side of things. But the future of Coinbase really depends a lot on institutions continuing to get involved in crypto. And so those two names, I believe, are the two that would be most directly impacted by the enactment of this bill.
Bob, you guys have partnered with companies like Galaxy and AWS on some of these build-outs. It's great to have you here, and you're coming to us actually from a conference of some of these data center providers. Is there talk about this backlash that we have seen, and what effect is it having, if any, on some of these projects?
Yeah, good morning, Julie. Thanks for having me today. There's a lot of talk about the backlash. Is definitely one of the top topics that everybody is addressing. And I think that one of the things that we're learning from our partners at Microsoft and AWS is that they are really leaning into a much better communication strategy. I think that's what most of the buzz is here, is that all of us in the space have to do a better job of communicating what the real facts are. What we're learning from our entitlement processes, where we're in town hall meetings, listening to the community members who are worried about their electric bills going up, is that the facts prevail. Our projects do get approved when there's rational discussions, and it's a ground game that includes meetings in people's living rooms, talking to them about what the reality is. Utility bills have gone up, 25% over the last 5 years, not because of data centers, but because the grid is outdated, and wildfires and all kinds of other things have caused the industry to have to realign the grid. And quite frankly, we have to upgrade our power in the US for a long-term view. But I think most of the utility companies are addressing the neighborhood concerns by telling them that the home utility bill will not be impacted by the data center construction. And President Trump weighed in even as recently as a week ago or so. We all agree that people's home utility bills should not go up because of data centers. And Microsoft and AWS have said they're going to pay their fair share or more.
Well, Bob, I mean, it seems to me, talking to some utility and power experts, that at least some of the increase in electricity partners to date has been from existing data centers, or ones that are, had gotten put on the grid before now. But it seems like that there is this push on the part of the big hyperscalers to your point, to shoulder a lot of that cost. Or do you think going forward that that's just the cost of doing business, that they're going to shoulder the cost of any increases in electricity or water for that matter?
Well, hopefully there will be a boom in advanced manufacturing and new onshoring of manufacturing during this administration. That's what the hope is, I think. And all of that will cause, the utility companies to have to power up and to realign their grid. And, we're hopeful as a builder to be, building more car plants in the US, more battery plants, more battery storage. So it won't just be data centers. Data centers are a big user of the power, but hopefully, we want a boom of manufacturing and new business across the United States, real job creators, and it won't just be the data centers as the kind of boogeyman. I think, as I said before, I've really been impressed with the hyperscalers' recent move into this argument to say that they're going to pay their fair share. They're signing long-term power agreements with the utility companies, which I think will strengthen both the grid and the power availability over the next 20 to 25 years. And again, I think it's having rational conversations with people across the spectrum in these town hall meetings. And when people really hear the facts, which are the driving thing that I think people have a misunderstanding about, is the job creation of these data center projects in the communities, which are vast, long-term, game-changing kind of labor numbers in these communities. And when people really learn and hear, the amount of dollars that go into payroll over the life of these data center campus construction projects, I mean, it's game-changing for their revenue streams, for their restaurants, their gas stations, their retailers. And then the long-term revenue is a game changer for their hospitals, their fire departments, and their personal security with their police departments. So again, we've been winning the battle, but it's a ground game, and we need everybody to be transparent. The hyperscalers, the developers, and everybody has to step up their communication game. I believe it's more of a communication problem.
Right.
And we all have to do a better job.
Bob, the projects that have gotten canceled that we mentioned at the top there, are they being moved to other places? Have you been seeing that happening? And if so, I would imagine that it takes a while, right? You got to do the permitting and site surveying and all of the groundwork. So
I believe a couple things. I believe some of those projects will go back and get approved. I think, again, people have to hear what's in it for them. They have to understand what the reality is instead of the NIMBYs have gotten very organized and are doing a really good job of spinning, what I think is a lot of misinformation. Like the what's in it for me is very beneficial to these communities when they really see the dollars and people are trying to attract other types of manufacturing into their communities, or casinos or other revenue generators, because they all have busts in their budget. When they really learn what a data center can do, a data center campus, like in Quincy, Washington, as an example, I mean, the place has brand new schools. The place has an amazing fire district. And all of that is because of the data center boom that came to their town. And it's, still has a small town feel. So,
and Bob, I am curious on the job front, because Quincy is an interesting example. They have a bunch of data centers too, so they've definitely gotten that influx of capital for municipal purposes. And you guys come in, and it seems to me that most of the job creation happens in the construction process, right? Like a data center itself doesn't employ that many people, right? Is it just a matter of the capital coming in?
No, I think that's a misconception. First of all, they take 4 or 5 years. The labor goes on, and you're talking about a data center campus that may have 1,500 to 2,000 workers who are making over $100,000. Some of the electricians today are making $185,000 a year. A lot of those are local people from those communities. I know in particular, our big hyperscaler clients are doing a lot of community outreach. We're doing apprenticeship programs, and we're bringing people into the trades that have never contemplated being in the trades before. But after we're finished with a data center, there's still retooling of the data centers. It's like the car plants. When we build a car plant, we actually never leave, because there's constant updating, there's constant retooling, there's replacing the servers. So while they say they may be 100 full-time technician jobs, there's another 300 or 400 jobs that are generated by a large-scale data center in the community. And if you look at Quincy as an example, we at Clayco have done, I don't know, probably several $1 billion worth of construction in that town over the last 7 or 8 years. It's been a constant labor driver into their community. And now there are really significant number of permanent jobs in those data centers. So I think that, again, this is getting in people's living rooms and in the town hall meetings and setting the record straight on the job creation front.
Ben, you're a venture capitalist, investor globally, right? And not just in tech, but in sports teams as well. So in other words, you've got a pretty diverse portfolio. And I'm curious how closely you're watching this increase in geopolitical tensions and whether it affects what you invest in.
It certainly does. I mean, I think today you need a degree in international relations rather than economics, or let alone the ability to dissect a balance sheet to navigate a lot of the turbulence. We've spent a lot of time in Asia, which in some ways has been hurt a lot by the geopolitical turbulence, particularly that between the United States and China, but now feels a little bit more of a safe zone as the president turns his attention more towards Europe. Europe was never a major target for us because we like emerging markets. We're here in the Middle East today. We like East Asia, Southeast Asia. And so we've targeted more what we would call kind of the next billion consumers rather than kind of yesterday's consumers, particularly those based in Europe.
Ben, do you worry at all that at some point the president's attention will turn? I mean, Venezuela is an emerging market, for example. Do you worry that his attention will turn to Asian emerging markets at some point, or can you not sort of operate that way? You just have to kind of go where you see the opportunities.
Well, I think China is kind of in its own parallel universe as it pertains to innovation, particularly around AI, core technology, hardware. And I think actually a lot of the risk that, people were pricing into China geopolitics is subsided significantly with very constructive dialogue between the president and his counterpart Xi Jinping. We always knew that this was a much more pragmatic, business-oriented president that wasn't as concerned with the intractable issues around China. And so I actually think and the Chinese themselves are very much prone to wanting to get a deal done. So I think that there's less geopolitical risk in that relationship, and there's more, frankly, in Europe, where there's a lot of pride and still a lot of unresolved hot wars and conflict that come into bear when you're trying to kind of balance European geopolitics with business opportunities.
So Ben, I mentioned you're also, and you said you're a tech investor. You invest in a lot of startups. And given your involvement in Asian markets, I'm curious how you think about the sort of AI arms race, if you will. There has been a lot of ink spilled, a lot of air expelled around this issue. What do you think in terms of the competitiveness between the U.S. and China on that front?
It's very much neck and neck. I think, the expectation is that by the end of this year, early next, we hit AGI. And I think that both, economies are now significantly decoupled and technology ecosystems are significantly decoupled. And so, you now have Chinese chip companies, of course, a whole parallel universe of Chinese hardware, Chinese LLMs. And so, and to some degree, there's more American dependence on Chinese outputs, be it human talent or rare earth magnets, you name it. And so I think the Chinese have actually sufficiently decoupled from the U.S. where, they still need the highest end NVIDIA chips, but more and more so they're breaking down kind of nanometer barriers on their chips. But the U.S. still depends on a lot of these, which I think is, again, one of the forces that's bringing the two economies to the table and really makes it so that decoupling is never truly feasible. But I think that, China is going to weather this storm relatively well because they've made it a whole country effort to design out U.S. products from their supply chain to enable their technology giants to grow in almost a Galapagos format parallel from the United States.
Ben, have you found that your capital as an American is any less welcome in the Chinese market?
American capital it's really the opposite. Obviously, there's been more barriers from the U.S. side restricting U.S. capital into China. China always had kind of what we call sensitive industries that were only ever allowed to be invested by RMB denominated funds, which we are not. And so it was more of an outbound investment restriction than inbound from the Chinese. But again, those two capital universes, I think, are now very much decoupled and separate. And so there's just many fewer US dollars flowing into China. And it's more the geopolitical swing states that are taking advantage now of that capital market decoupling.
And Ben, as you look ahead here to 26 and 27 for that matter, you talked a little bit geographically about where you're seeing opportunities. I'm curious sort of, in subsectors or particular technologies, what are you finding most exciting right now?
Well, obviously, our view is that the impact of AI across the entire work stack and consumer value chain is going to be much more pronounced than perhaps people are willing to admit. And that will cause significant job displacement. But of course, that means also that the companies that are integrating AI into their entire workflow, be it scientific, biotechnology, enterprise, are going to be great beneficiaries here. And so on the one hand, there's been obviously a theme that there's a bit of an AI bubble. And I do think that the AI kind of mega companies perhaps need fewer chips than has been headlined, less energy. For instance, I don't think I'd want to actually be in the data center space right now or the power space. But I do think that the downstream applications, again, across the world, and particularly in the United States and China, are where a lot of the excitement lies today. And then dealing with all of that job displacement, how do we ensure those people are leading productive lives and still fully integrated into society? That will provide, I think, interesting opportunities as well. And that's why sport is interesting to us, because we think sport is very much recession proof. It is decoupled from the rest of the economic cycle. And in that regard, it's kind of a contrarian play on everything we see around us.
I'm glad you brought up sport because I wanted to ask you about that as well. You are a chairman and you founded something called the Harbor Group, which has ownership of soccer teams, particularly in the Mideast. I'm curious about prediction markets there. Have we seen prediction markets break in there? And has that increased sort of fan engagement at all, like we've seen it to some extent happen here?
Not as much. Obviously, gambling of all sorts is outlawed, particularly here in the GCC, and I guess now the UAE will start to legalize it, but certainly not here in Saudi Arabia. I'm sure it happens offshore, but it's not something that it trickles its way in. But this is still very much an authentic football fan market. Over 75% of Saudis would kind of declare themselves football or soccer fans. So the sport really has a monopoly on the market. It's where all eyeballs are tied for match day. The national team is a source of pride and also sometimes tribulation. But it is very much more about the increased monetization around the sport, be it game day revenues, merchandising, sponsorship, TV revenue, than prediction markets or gambling.
Hi, Claire. So tell us about D.R. Horton's quarter, first of all, and what we heard from them amidst this housing market backdrop.
Hi, Julie. Yeah, so I think the thing investors are focusing on this morning is this profit number that fell 30% from a year ago. It did beat analysts' very low expectations, but that's not where you want to be. And it's a reflection of just the continued challenges in the housing market right now when it comes to affordability. Revenue was also down to $6.89 billion. That was down from $7.61 billion. And they talked a lot about how they think they're going to continue to need to do incentives. That's things like mortgage rate buy downs and just additional sweeteners to get people to buy homes in this current environment when housing is just so expensive and people are really feeling pinched.
This is so interesting to me, Claire, because it really, my ears perked up because you and I have been talking about this for a while. When Bill Pulte talked about that these companies are making money hand over fist, because that's not really what's, certainly from a margin perspective, as they keep offering incentives, that doesn't really seem to be what's going on in this current environment.
Right. I mean, pretty much all builders, Horton included, have really seen their margins compress. They are still healthy, but they are really taking a hit here because they're trying to get people into homes and people are not really wanting to buy them. And, Pulte has talked a lot about buybacks being an issue. And I will say that D.R. Horton is a big buyer back of stock. They repurchased over 4 million shares this past quarter. They also pay dividends. Pulte, I think, wants to see them put all that money back into housing supply and build more. But D.R. Horton doesn't want to do that if the demand is not there, because the big risk is that you end up really hurting the people who just bought homes from you because home prices then would fall. And it's really this sort of tug of war between the people who have already bought and the people who want to buy for the first time.
Claire, did they address the buyback pushback from Pulte at all?
Yeah, so we didn't hear anything on the initial report that came out this morning, and the call is sort of ongoing now. But, I think we'll have to kind of see how the builders approach this. This is not going to be something that they are going to want to get rid of. This has been one of their main tools to really reward shareholders in this kind of tough economic time when it comes to actually buying.
Claire, thank you so much. Appreciate it.